Welcome to another Miller Value Partners live discussion, April 2025. Thank you for joining us. I'm David Yazdan, and I'm joined by my colleagues, portfolio managers Bill Miller IV and Dan Lysik. Today, Bill and Dan will provide updates on specific investment opportunities. We'll discuss the current market volatility and how that favors active managers over passive strategies. We'll address tariffs, what they are, and their implications from an economic perspective, and why we take an outside view on the market, meaning what's not in the news. So at Miller Value, we believe that markets are inefficient at times, often wildly inefficient, particularly in small caps. We've been calling your attention to the opportunities and the relative attractiveness of small caps over the past few quarters. So today we'll give some love to mid caps, which are also offering value investors bargain entry prices. We'll highlight how having a long-term mindset allows us to take advantage of dislocations in public markets and why we believe the current uncertainty is short-term in nature and provides us with great long-term buying opportunities. After our prepared remarks, we'll open it up to Q&A. If at any time you have questions, you can click on the Q&A icon at the bottom of your screen, type in your question, and then press submit. We'll address your questions at the end. So by now you've read all of the Chicken Little, the sky is falling headlines and received the hand-holding emails from your advisors and fund partners to stay the course. So we won't belabor this topic. However, I saw this chart sourced by Franklin Templeton and thought it would allow us to discuss the importance of portfolio management. Yes, this chart is intended to remind investors that we've been through periods like this before, to ignore these painful but short-term market swings and focus on the long-term picture. And we agree with all of that. But it also reminds us that the market frequently offers us opportunities of which to take advantage. The chart shows calendar year returns for the S&P 500 index since 1995 through 2024. That's the turquoise or teal colored bar. The bluish purple bar shows the largest peak to trough decline in the index in that same year. So for example, in 2003, the index finished the year up 29%, but suffered a 14% peak to trough intra-year decline. And in 2010, the index finished up 15%, despite having an intra-year decline of 16%. Even as recently as 2023 and 2024, both years of strong overall performance, there were meaningful intra-year retreats. And mind you, that's just for the large caps. When you look at small caps and mid caps, historically, due to a combination of being less liquid and under-researched, we often observe even greater short-term mispricings. So great stock pickers aren't always great portfolio managers. In our conversations with institutional investors, we benefit from hearing about their experience with successful managers over decades. And many say it's a combination of security selection and sizing positions effectively. Some have said the most successful managers they've invested with are those that size up their highest conviction opportunities and trim or exit positions decisively that are either fairly valued or where the investment thesis has changed. And for the most part, we agree. Trafficking in small and mid caps, maintaining concentrated portfolios, and managing smaller pools of capital are all factors that enhance our ability to resize or manage portfolio holdings when Mr. Market offers us the opportunity to do so. Conversely, as behemoth funds continue to gather assets, the big get bigger, and it becomes more difficult, if not impossible, for them to size up positions or exit holdings without breaking a lot of glass, particularly if they desire to fish in the target-rich pond of sub-$20 billion market cap companies. To put that into perspective, as of December 31st, 2024, less than 4% of the S&P was invested in sub-$20 billion market caps, while over 3/4 of Miller Value Partners Appreciation ETF, MVPA, was invested in sub $20 billion market cap companies as of 12/31/24. Now for a brief update on fund performance for the quarter ended March 31st, 2025. It was a challenging quarter, and the first week of April was also challenging, no doubt. However, I'm reminded of the quote from legendary value investor Shelby Davis about times like these. You make most of your money in bear markets, you just don't realize it at the time. For Q1, Miller Income Fund, symbol LMCLX, which is the iShares, returned a negative 3.81%, underperforming the ICE Bank of America High Yield Index, which returned 0.96%. However, zooming out over longer periods, Miller Income Fund has outperformed this index in the 1-year, 3-year, 5-year, 10-year, and since inception time periods ending 3/31/25. Miller Value Partners Appreciation ETF, symbol MVPA again, returned negative 8.94% for the first quarter of 2025, underperforming the S&P index, which again returned negative 4.27%. But again, since its inception on January 30th, 2024, through quarter end March 31st, 2025, so roughly 14 months, MVPA returned 26.38% versus 15.81% for the S&P 500 index for that same period. So outperforming the index by over 1,000 basis points in roughly 14 months. And then finally, Miller Value Partners Leverage ETF, MVPL, returned negative 8.84% in the first quarter, also underperforming the S&P 500's negative 4.27% for the quarter. However, since February 27th, 2024, inception through the end of Q1, so roughly 13 months, MVPL returned 13.6% versus 12.17% for the S&P 500 index. Now, with that intro, let's start our discussion with Dan Lysik. We'll share more thoughts on the long-term opportunities resulting from the current rise in policy uncertainty, as well as an update on a new position in the housing space. Dan?
Thank you, David. We put together a couple slides similar to the last couple quarters to kind of run you through some interesting data points that we've picked up, and I'm sure all of you are constantly noticing this as we kind of work our way through the second quarter. So this first slide highlights rising U.S. policy uncertainty. And this chart looks back over the last 40 years, and prior to the COVID time period, the August 2011 spike was the U.S. debt downgrade, and that was considered an outlier, peaking near 300. In 2020, the significant COVID outbreak drove the uncertainty index to an unprecedented level, greater than 500, during the month of March. And as you can see at the end of March of this year, it actually spiked back up to 446, likely much higher today. So 2025 are the only two outliers over the past 40 years that you can see in which the level of uncertainty has gotten to the point of what we're seeing today. Now, it's not only the high level of uncertainty, but it's the speed in which it went higher and the confusion in the marketplace over tariffs and unknown potential future kind of economic impact. And Bill's going to discuss tariffs shortly in more detail. If we turn to the next slide, here we want to highlight, looking at these two charts that show kind of periods of high uncertainty have led to kind of attractive long-term returns. And the greater the level of uncertainty has tended to be coincided with greater long-term returns. The chart on the left shows forward 1 month, 3 month, 6 month, and 1 year returns for the S&P 500 following spikes in the U.S. policy index that we just looked at. First bar is each time period is the peaked uncertainty level of below 150. The second bar is uncertainty index between 150 and 179. And the last bar was an uncertainty level over 180, like today. As you can see, the greater the uncertainty level, the greater the attractive 1 year return for the market, looking out over a 1 year time period, with returns on average over 20%. The chart on the right looks at consumer sentiment index, and it goes back to 1970 time period. The blue dotted line in the middle is the 55-year average, which is at 85. And the shaded bars are historical recessions. Gray are the uncertainty. Market volatility has historically led to falling consumer sentiment. And at the end of March, we ended at 57, which is similar to kind of historical recession time periods. But the important kind of takeaway from this is when you go forward 1 year, you can see that there's attractive double-digit returns, and the returns in most cases end up being in excess of 20%. So on the next slide, what we want to get at is we've talked in the past about market structure. And while the marketplace may look to rush back into the longest duration equities as we get past this volatile time period, these still remain crowded and are less attractive in our opinion. The chart on the left is the Russell 1000 growth to Russell 1000 value. And there's a smaller subset chart, and you can see that the returns during the 1980s were very similar. That was followed by significant growth outperformance in the 1990s, which was completely erased during the 2000 time periods. And then growth led again coming out of the 2008-9 recession, and their valuation spreads actually were narrow between value and growth. And while there was a pullback post-COVID, the 2020s have continued to favor growth, and we've seen further widening of valuation spreads. Given the current ongoing market concentration we briefly mentioned and the wide valuation spreads, the environment today looks very similar and has similarities to the 2000 time period. And as you look at the chart on the right, you can see the returns from 2000 to 2006. And again, looking where we're sitting today versus that time period, that's when small and mid-cap values significantly outperformed over that 6-year time period, outperforming large cap growth by 150 to 215%. On the next slide, just taking a little bit more of a look at what we saw with these longer duration equities. During the Q1, the market cap of stocks with a price to sales greater than 20 times had touched 6 trillion. That's 1 trillion above the 2021 peak and nearly 50% above the dot-com peak. On both instances, once the peak is achieved, valuations are reset. Total market cap of this subset falls 80-90% over the following 1 to 2 years. Historically, companies with price to sales greater than 20 times have less than a 30% probability of outperforming in the market when you look out 1, 2, and 3 years. And as you can see on the chart on the right, as you move more than look out 10 years, more than 50% of those companies actually get delisted. So high valuation, high future growth expectations are a significant risk if future growth disappoints, which leads to significant valuation contraction. On the next slide, we're going to highlight more detail where we think the opportunities lie today. So again, within mid-caps, if you look at mid-caps historically, the chart on the left is their weight of the Russell 1000. Mid-caps have historically been closer to 30% versus the low 20s today. In addition, looking back to the 2000 time period that we just highlighted previously, mid-caps started to outperform. They were at a 25% weighting. So today we're at 60-year lows. Again, lack of ownership that's in the marketplace today. Also looking at the chart on the right, you have record low representation that's due to wide valuation spreads. The Russell 1000 price to sales relative to mid-caps are near a 60-year high. So mid-caps are attractively priced at levels similar that was followed by multi-year time period of outperformance. And on the next slide, the final one we have for the market, highlights small caps and the growing opportunity that we continue to see today. Small caps peaked in November of 25th of last year. Since then, they're down more than the first half of the average recession time period. And the chart on the left highlights more cyclical subsectors of the Russell 2000. And within that, you can see how we're even worse within the cyclical part of the marketplace in small caps. So again, discounting what we believe is much worse than what you've seen historically the first half of average recessions. In the chart on the right, while small caps will lead the marketplace lower during the first half recession, mid caps will also lag large caps during that time period. Small and mid caps are up double digit during the second half of recession. And it's worth mentioning too that recessions are usually called well into the recession, if not in some cases actually coming out. And then the excess return 1 year after the recession, you can see in small caps and mid caps are in excess of 30%. So we think these two subsets not only are positioned for under ownership to benefit from the marketplace today, We also see them being beneficiaries as this year progresses, ongoing deregulation and further kind of tax relief. There are two policies that are being, pushed forward by the administration. So recovery with the market broadening should further, we think, start off a multi-year outperformance cycle in favor of lower valuation securities, small and mid caps. On the next slide, kind of set the table for one stock we want to mention this quarter. This first chart highlights, if you look at the housing marketplace today, and specifically what we're focusing here on is existing home sales. And within the housing market, they look very similar to 2008, 2009 time period, down 15 to 20% for the past 2 years. And we know this has been due to housing affordability, rising home prices, and also with higher mortgage rates. Historically, the long-term average for mortgage rates is 170 basis points over the 10-year bond yield, and today we're sitting at 250. So returning to historical average over time, we will likely see mortgage rates fall closer to 6%, which likely also will help the affordability and translate over time to better housing trends. And if you look on the next slide, I wanted to walk through briefly JELD-WEN, symbols JELD. This is a market-leading North American, European manufacturer of interior and exterior doors, windows to not only the new construction market, but restoration and remodeling marketplace. The shares today trade at $5 a share, down more than 75% from the 52-week high. Gen Weld actually has a new management team in place, undertaking a multi-year transformation. And here we don't necessarily need to focus just on the housing improvement, because if you look at the company today, they're actually right-sizing the manufacturing and distribution footprint, making $150 million investments in automation, robotics, and systems to further kind of drive efficiencies. We should see about $100 million plus of incremental EBITDA added to these efficiencies over the next couple of years. And if you look historically, there's $350 million of fixed costs that were pulled out of the business over the last couple of years. So any improvement over the 12 to 18 months on the housing market leads to 25 to 30% incremental margins for JELD-WEN. Profit margins will trough out this quarter. There's additional cost savings, which I think should work its way through the business model and start seeing improvement by the back half of the year. And the transformation, this is a sizable company with a $4 billion revenue base. So getting to low teens EBITDA margins supports greater than $500 million EBITDA. And if you look at private market transactions in the marketplace, one of their largest competitors was acquired last year, 8.6 times enterprise value EBITDA. That supports, on success of the transformation, an equity value north of $3 billion. Today, the market cap is $450 million. So again, no transformation plan is currently in the share price. Near-term risk, prolonged revenue or profit trough could delay that EBITDA improvement 2026, but the company owns a considerable amount of real estate within their footprint. We think that provides margin of safety in any downside scenario. Also want to mention that if you looked at the balance sheet and the debt, Gen Weld's 2032 debt, we think is highly attractive. There's no maturities for the next 2 years. The debt stack is covenant light. We think it provides management a lot of flexibility in managing the balance sheet during this transformation plan. So with that, I'm going to turn the call over to Bill.
Thanks, Dan. I appreciate that context around valuation and cyclical changes in the economy. Very helpful. I'm going to pop in here to the topic du jour, which is tariffs. First, I want to talk about what they are and their implications from a classical economics perspective. I also want to talk about why we take the outside view on markets. Third, I'm going to tell you about what the market can maybe tell us more about what's going on. And then finally, I want to talk about what we're doing in this environment within the portfolios. So first, what are tariffs? They are taxes enacted by nation states against other nation states for the goods and services sent to our economy from those nation states. So what they effectively are is taxes that prioritize nation state identities over aggregate consumer prosperity. So if you go back to 1817, David Ricardo wrote On the Principles of Political Economy and Taxation. And it pretty definitively showed that the world and consumers as a whole are better off under conditions of free trade. So I think one of the retorts here is, well, yeah, that's might be true, but we didn't have free trade before. All these other nations are taxing us, and therefore we need to right size things. Okay, well, I don't necessarily disagree with that at all. But actually, if you think about, a lot of people think this is the art of the deal. From my perspective, what's gone on is Donald Trump just went and punched China in the face and said, "Now give me a cookie." I don't know how well that's going to work. I don't think there's a great precedent for that working all that well. I think we may get some strategic, concessions here and there, but in the aggregate, is it really going to make a huge difference? I don't think so. But either way, that doesn't matter because we take an outside view on things. So David actually introduced that up front by showing the average drawdowns in the market and then what happened thereafter. So effectively what happens if you look at the system as a whole, after a big violent drawdown, especially over a short time period like the one we've seen, generally speaking, the forward returns after that are much, much better than they ever have been under other circumstances. So this is a buying opportunity. The world is a big, complex, adaptive system, and there's a lot of great news out there that you don't hear about when all the headlines are dominated by tariffs, inflation, people fighting. So what's not in the news? Here's something that's not in the news. Trueflation, which is a live time measure. I encourage you to check it out if you're not familiar with it, trueflation.com. They just printed the lowest reading in 4 years for inflation of 1.2%. That's live. And this is visible around us everywhere we go. Average gas prices nationally today is $3.22 a gallon. That's down 11% in the last 12 months. Egg prices just tanked from $8 a dozen at the end of February to $3.60 today. Now, how about our dollar? Well, the dollar has tanked 10% since the beginning of January. You know what that does? That makes our exports a lot cheaper. So we've seen a lot of things already start to adapt. The world's already adapting to what's going on. And in fact, we've already seen this story before, if you don't remember, which is in 2018, Trump did the exact same thing in his first term against China. And what happened then? Well, the market tanked 20%. And then monetary authorities got on it, and they started to, in 2019, they pivoted entirely. So they went from a hiking cycle to an easing cycle. In July of 2019, they cut rates. And then in September, they started printing money and buying assets and putting them on the balance sheet again, and everything was okay. But if you actually waited for that to happen, you were behind the curve because the market got to a new all-time high shortly after that December's swoon. And it was a new all-time high in April of 2019 before any of those other actions ever happened. So it pays to stay the course because the world adapts, it gets better, we all move forward, and things progress. And so one of the other things I like to do in this sort of scenario is look around the markets and try and figure out what other investors and their expectations are and back into those based upon what's happening and what they think's happening at the margin based upon all of these new political changes. So our credit spread's telling us the economy is about to collapse. Not yet. So right now they've blown out from a 10-year low, okay, 10-year low, probably too tight, 277 bips in January of this year. Well, right today, as we sit, they're 450 basis points. So they've blown out. Should we freak out? Probably not, because for context, the average credit spread of the high yield market over the past decade is 442 bips. So we're in line with the average over the past decade. High yield's blown out a little bit, but it's not freaking out at all. All right, well, let's look at what the U.S. bond market's telling us. Let's take a look at the 2 to 10 year spread. Really interesting action here, because what's happened is the 2 to 10 year spread has steepened meaningfully since all of this stuff has happened. Steeper bond curve. We're looking at the steepest level of the 2 to 10 year spread since the beginning of 22. And that was when the curve was in the midst of a major flattening. Now we're seeing a steepening. So we could be going into a very long and nice economic expansion here. And that's not in the news. But that's a market-based and very powerful indicator for things that people should be considering, and they may be not. It's a very powerful consider for long-term equity owners. One thing that Dan Lysik flagged for me yesterday, which I hadn't realized, is the market peaked on the exact same day this year, February 19th, as it did in 2020 prior to the COVID crash. Why do I mention that? Well, there's probably other technical factors that could be causing these kind of things too, such as tax day in 5 days. People don't want to be paying their taxes and being forced to sell when the market's in the dumper. So maybe people were trying to get ahead of that. Who knows? But it's an interesting alignment there, especially when you consider all the other positive signals coming from a lot of other places in the market that people aren't talking about. One of the common questions we get is, well, what are you doing during all this? Aren't you managing the portfolio and changing it all around? And the answer is no, not really. We're not doing a ton of stuff, because when we look at the world and we evaluate a name under typical circumstances, this particular situation, which is a moment of dislocation from our perspective in the markets, this is not our base rate. This is not where anyone should be selling assets. To get a return that's different than what's in the market, you need to do stuff that's different than what everyone else in the market is doing. And so we are evaluating all kinds of opportunities that are out there. But if you think about active managers and what we do, we're in a constant OODA loop. OODA meaning OODA, observe, orient, decide, and act. Well, if you think about an investor who manages a fund, all of the costs are incurred in that last one, that A, right? When you actually act and you buy or sell a security, you're incurring taxes on the sale, you're incurring a market impact, and you're incurring commissions. So your insight better be darn good when you make those decisions, and it better be better on aggregate than the market to outperform the market. So we're in the midst of observing, orienting, and deciding here. We're not doing a ton with regard to our regular names. We're trying to figure out if any of them are going to be, irrevocably impacted by any of this. The answer so far is no. But we are looking around the markets and seeing some interesting opportunities they're new opportunities. So if you're a close follower of MVPA and you look at what we own every single day, some people out there do, you notice we bought yesterday a company called Venture Global, VG. So this is a starter position, but it's super interesting for a very interesting reason. They're an LNG manufacturer and exporter. But why is this a really interesting name? So it IPO'd 2.5 months ago, end of January, IPO'd at 25. Biggest energy IPO in 4 years. So a major process occurred to price this stock and figure out what the optimal, what a rational price was for buyers and sellers. Everyone decided on $25 a share. It's now at $7. Okay. And the managers, who I don't believe sold any shares as part of the IPO, just ponied up like $50 million a few days ago at $10 a share. It's now at $7 to increase their position. They own 81% of the thing. These guys are billionaires. They're very smart people. They're loading up. So are we big LNG fans? Natural gas market looks okay. Do I know a lot about natural gas? Am I a natural gas expert? No, but I understand that fact pattern. So that's taken the outside view on a stock based upon very interesting characteristics of what's going on. So there are opportunities out there like that. It would be surprising to me if Venture Global was a bad deal at this price, given those sorts of dynamics. That said, it's not the largest position in the portfolio. It's about 2%. And we're going to continue evaluating it and doing more work on it and figuring out whether or not it needs to be bigger or not. But there are things out there to do. So that would be one example. David mentioned MVPL. We're not known for, historically speaking, Miller Value Partners is a stock picking shop. That's what we're known for. This is a very different process. I want to just do a 1-minute pitch on MVPL because it's by far, in my opinion, the most under-owned fund that we have. There's only like $6 million in it. Most of those are ours. But from inception, end of 228 last year, through today's close. Okay, so just to remind everyone with this, it's a systematic leverage fund. It's either 1 times S&P or 2 times S&P at all times. Since inception, it's ahead of the S&P. So MVPL is at 5.99 versus SPY at 5.26. And if you look at SSO, which is the full-time levered version of the SPY, it's levered SPY is down 60 bips. We're up 599 in the systematic fund. I think it's super interesting. I think it's potentially will if we look back in 10 years, it may have the highest IRR of any fund we own. It's only got 5 million or 6 million bucks in it now, but I just wanted to pitch that because I think it's a super interesting idea. And so the whole idea is there are certain environments that are optimal for leverage and certain environments that are not optimal for leverage. And that's based upon first principles of math and compounding. And the strategy is done exactly how we thought it would, and we're excited about it. And I just wanted to pitch that briefly before we move on to the next section of the call here. Also, I'll turn it back to David. I think we're probably going to go through some questions that have been submitted ahead of time, as well as anything that comes in now. So thank you for your time and attention. We really appreciate it. We take our responsibilities very seriously and appreciate your guys' attention and partnership. So thank you.
Thank you, Bill. Yeah, before we jump to the Q&A portion, for those of you who are invested with Miller Value, we thank you for entrusting us with your long-term capital. For those who are still considering an investment with Miller Value, we appreciate your interest. please reach out to me or my colleague Michael Roscoe directly to tell us what you need to assist in your research and your ability to invest. Michael's email address is mroscoe@millervalue.com. That's MROSCOE at millervalue.com. And it's also listed here in the chat section. Investor access to Miller Value Partners Appreciation ETF, again, MVPA, has been expanded, as the ETF is now on Schwab, Fidelity, Janney, and many other custodians and platforms. We're working hard to expand where investors can buy the fund, and in the latter part of due diligence and approval for several larger platforms. For advisors on this call, if you are still waiting for your platform or custodian to approve MVPA, please contact your home office. MVPA has met all of the quantitative metrics required for approval at most platforms, and the final step for approval is your home office to hear from you and request that you want to invest in MVPA. We thank you in advance for your support and assistance. So now on to the Q&A portion. Again, as a reminder, if you have a question, you can click on the Q&A icon at the bottom of your screen, type in the question, and then press submit. So the first question looks like it's probably for Bill. Please share some comments around the Bitcoin miners such as BTDR. Have you owned them in the past? If not, would you be open-minded in investing in a Bitcoin miner in the future?
Thank you for that question. And I should have mentioned more about Bitcoin in my introductory remarks, so I appreciate it. What I think is really interesting about Bitcoin right now is if you look at the drawdown during this tariff sell-off, it's down about 25 or 30%. If you look back at Bitcoin's drawdown in the tariff sell-off of 2018, 2019, it was down 54% at its peak. So that, again, the market was down 20% then. It's down 20% now. And Bitcoin's only off 25 or 30%, while the last time it was down double that. So the point here being, the world changes, people's perceptions of things change, correlations change over time. Another really interesting dynamic going on in Bitcoin right now is the Bitcoin dominance chart, which is effectively Bitcoin market cap divided by total cryptocurrency market cap. It's at a new multi-year high, which is really interesting because when you consider the fact that the Trump administration was very pro-crypto as a whole. And so when they came to the office, the Bitcoin dominance kind of dipped a bunch. And now it's, again, soared way beyond that. So Bitcoin is maturing, it's coming of age, it's dominant. And another thing that's super interesting, if you had asked the typical market observer how MicroStrategy would have done year to date in this sort of market environment, they would have said it'd be down 20%. It's outperforming the market year to date. So I think that's super interesting too. Now, on to the miners specifically, we do not own any miners. We have in the past. We owned a company called Stronghold Digital, which was using stranded coal to mine Bitcoin. That was a massive mistake. I think most people that have bought Bitcoin miners have found that to be a mistake. It is a very challenging, the Bitcoin mining process is a very challenging process. That does not mean that the world will not change over time and we may eventually buy a miner. I don't know. We don't own them now just because we feel like the risk reward is better in something that directly owns Bitcoin, whether that's a, capital allocation machine like MicroStrategy or a core business plus Bitcoin treasury strategy like Semler or something like GameStop that we initiated a 1% position in MVPA. But we like owning the protocol directly more than the miners at this point. That doesn't mean that may not change. But again, the Bitcoin mining business is a very challenging one, and we have not found a valuation or a scenario where we thought it was better to own the miner over the protocol yet.
Thank you for that, Bill. Next question is probably start with you, Bill. Dan, you could probably chime in maybe on this one too. Are you intrigued by any of the opportunities in AI data center and related power energy demand?
I am. The one name that I repeatedly repeatedly kicked around and not bought, and repeatedly kicked around at much lower levels, is a company called Vistra Energy, VST. It's an independent power producer that has the opportunity and has been making these power centers for AI. But I think that's a really interesting potential name. I think the free cash flow yield there is interesting. I think the long-term opportunity there is interesting. We haven't done anything. We might eventually. Still need to do more work on it, though. But I'm sure there's opportunities. I shouldn't say I'm sure. I would imagine there are opportunities in that space.
Okay, good. Anything to add to that, Dan?
No, the only kind of quick thing I'd maybe mention is that while the market's kind of focused on direct players in that space, I think a lot of the energy solutions that come about from also kind of traditional energy companies probably are being overlooked. And those would be, I think, theoretically free call options today. So that might be another way to think about playing that, which I don't think is getting a lot of credibility today in the marketplace.
Sure. Thank you for that. Okay, this next question is for Dan. Please speak to the investment thesis behind Lincoln Financial, symbol LNC, and Jackson Financial, JXN is the symbol. Do you see a favorable theme around growth of annuities or other similar retirement products?
Thanks. I think maybe the first way to kind of briefly start about it is periods, like we're going through right now with market volatility. Usually come out of this, investors' demand for annuities go up. Also, in regards to annuities, just to set the table here, there's an asset kind of shift taking place in the marketplace. Baby boomers have moved kind of into the retirement kind of phase, and assets are transferring from 401ks. And so that's leading to some greater demand, I think, for annuities too, to provide stable income past retirement. So I think that's another kind of wind at the back for the annuity players. Jackson specifically, that symbol is JXN. It's one of the top annuity providers, industry-leading product suite. They have a great in-house, what I would say is essentially a platform for underwriting and monitoring, and a leading distribution network tied into 500 broker-dealers, 120,000 advisors, and a management team that's been very successful managing through these kind of different business cycles. They were spun out of Prudential PLC in 2021, and they've led the industry in returning capital, nearly $2 billion to shareholders, raised the dividend by 40%, and they bought back nearly 20% of the shares. So to us, with the share price pulling back and being caught back with financials in general and the weakness, to us looks like a great buying opportunity. It's near a 30% earnings yield, less than half the book value, 4.5% dividend yield, and the company should still deliver 12% plus ROE. So we think the upside there to double in share price over the next couple of years is pretty attractive. And then just briefly on Lincoln, the insurance business is what got the company in trouble coming out of COVID, with all the insurance companies and the assumptions and capital that's underlying all those insurance contracts. That overhang is behind the company, yet still that business is at break even. You have a new management team that's turning around the business. They successfully delevered the balance sheet. Capital intensity has gone down for the product offerings. And in focusing on free cash generation, doubling the free cash flow conversion next couple of years. And yesterday they had a new product, or actually a new partnership announcement with Bain, which is a 10-year partnership. It's going to provide asset management services. This is very similar to what Blackstone did with AIG's life and retirement business, which was really successful when you go back a couple of years ago. So the incremental capital is going to be focused on growth initiatives. Again, return on equity and 12% or greater. And it's going to help them position the life segment to actually return to growth. So we think today the turnaround's got limited value in the share price. The PE's at 4 times, half the peer group, and their price to books half the peer group. Nice, attractive 5.5% dividend. So we think success in a turnaround next 5 years, Lincoln should be, anywhere from 2 to 3x current share price.
Great. That was great. Thanks, Dan. Next question is on Pubmatic, symbol PUBM. Are you still constructive on the name, and do you think the platform is being disruptive?
Good question. That was a mistake. That doesn't mean that in a recessionary bounce back scenario, the stock doesn't outperform the market. It's an ad tech firm. We also made a mistake on Ibotta. IBTA was the ticker on that one. We banked the tax loss on both of those with a sale just because the competition was much more cutthroat than we had anticipated when we bought them. And it just continues to be intense. And so we're wondering how much they can actually eat into some of these other legacy major platforms like Google and other things like that, and whether or not they'll eventually just be competed out of there. I don't know. But we do know that we have more confidence in other opportunities, so we moved on from those.
Okay. That's so you were able to recycle the proceeds into some relatively undervalued or maybe even the new position.
Correct.
Okay, the next question is, how do you feel about Gannett, symbol GCI, even after the departure of their CFO? To Dan.
Yeah, so Gannett, for anyone who's not familiar, it's a multi-year transformation to become a digital media company. The CFO who stepped in has been deputy CFO and very instrumental in building the transformation plan the last couple of years. Company should be close to having half the revenue coming from these digital revenue streams that are growing high single digits to 10% over the next couple of years. So the risk is the secular growth, or I would say secular shrinking of the newspaper business, which we think again becomes less of a concern as you move past this year into next. Just given the size of that portion of the business, the balance sheets improved dramatically, and so again, like we always focus on management teams and changes. We like the person who stepped in, and we think the turnaround continues to be on track longer term. We'll also have some further comments coming up in the quarterly letter once that kind of hits and gets posted.
Great. Any update on their legal fight?
Great question. So they're challenging Google for their ad tech business. The DOJ's got a similar case. That court case has been completed. We're waiting for the judge to actually provide an update. So hopefully we would hear something over the next month or 2 months. That's also not given the weakness in the shares. There's no value potential for that. And Gannett has shared historically. They believe there's a potential reward that could be in excess of $1 billion on success, and then going through an appeal process, just given how they've been adversely impacted historically. And so again, we'll have to wait for the DOJ case, and then you have state cases lined up. And I think Gannett's case is scheduled to go to court probably later this year at some point.
Okay, great. Thank you. Next question is, again, for you, Dan, how affected is Neighbors by the possible reduction in shale gas production?
So I think any energy service company, if you look at them today, we own Technic, FTI, and MVPA as another name. I think the market has been priced in with weakness in general, just concerning on what's pulled back on commodity prices, that we could see some further CapEx reductions that's taking place potentially over the coming year. We've already seen a pullback because of the consolidation that's happened at E&P players. So again, while there's some risk of that, I think the share prices across all of energy service, which is down 30 to 40% plus year to date, I think kind of discounts a significant amount of that risk. And as we look forward, we think again the low cost operators. We highlighted Neighbors within the land drilling space, also Technic, FTI, which is subsea. We think those companies would do quite well when you look longer term, and think shares look pretty ridiculously priced today.
Okay, great. Thank you. Next question would be, would you consider other leverage funds like USD or SOXL instead of SSO based on its relative attractiveness for MVPL?
Actually, by prospectus, we can't. So the only thing we could do in that fund right now is be 1 or 2 times S&P. And so that's what that's what the entire model is geared towards. So putting another ETF in there, or using another levered ETF, is not something that would work with our current IP. So we couldn't do it. No, it's just 1 times or 2 times S&P at all times, every day. And we have a signal at a certain time every day. We look at the signal at that time every day, and we make a decision based upon the signal at that time.
Got it. All right. A couple more questions. This one, would a recession be detrimental to small cap holdings like Gannett and Fossil, or should they be able to weather the storm? Thanks.
So I think if you look back historically, what we try to do at the firm is focus on, companies that we think have a strong asset base, have strong market share positions, that have sizable revenue streams. So while they may be small in market cap size, a lot of these companies, when you peel back the onion and look at them, they're actually should be more appropriate to be a larger small cap or even a mid cap from a market cap perspective. So there's multiple levers that can be pulled by these companies when you go into a downturn. You can right size the business, you can sell non-core assets, and there's a large enough a business where you can do a cost reduction program to actually help offset kind of recession time periods. And again, focusing on the balance sheet maturities near term is critical to that. But that again provides the opportunity, as Bill was highlighting before too, coming out of recessions, if we go into one where a lot of these companies will get revalued and make significant returns looking out 12 to 24 months, and that's similar to what we saw coming out of the COVID time period.
Okay, thanks, Dan. Okay, this next question comes from Bill Miller. Have you looked at CRWV, a former Bitcoin miner turned data center operator that is now a $20 billion market cap after its IPO? CORZ is a miner that has a deal to provide compute to CRWV and has a $2 billion market cap and perhaps could be acquired by CRWV. An analyst pegs CORZ's price in a deal is around 3 times the current price.
No, but thanks for the question, Dad. I'll take a look at it now, though. Thank you. I've not looked at that one.
That's great. Okay, we have one last question. Any comments on GTN, which I think we talked about?
I can quickly take that one. So
Okay.
that's Gray Media, and again, we continue to like that company on the equity side and the debt side. Continue to believe it's again being caught up with concerns in the marketplace on recession and near-term pullback in advertising. The equity is trading at less than 1/2 of annual cash flow, which to us looks ridiculous. Pays a 9% dividend, and with the long-term debt trading in the 50s, close to 60, we think again that's an incredible opportunity. Company should be able to generate $2.5 billion plus of free cash flow when you look out over the next 5 to 7 years. A very smart CFO, no near-term maturities too. So we think that's an opportunity that's presenting itself that's pretty attractive in our opinion.
Very good. Okay, thank you. We do have one more question. What are your thoughts on Fannie Mae stock?
Fannie Mae and Freddie Mac are both super interesting opportunities. These are companies we believe have a very high probability of being reintroduced to the private marketplace again. And in that scenario, we think they're worth 4 to 5 times the current price. And if you look at all the political actions going on around them, I think Bill Pulte, who's in charge of the thing, just tweeted out like yesterday. He turned over the entire board, the entire management team, and he tweeted out yesterday that there's an entirely new energy here. These are entirely different companies. So all of the evidence and all of the news flashes and releases continue to suggest they're progressing towards privatization, and we think they're worth meaningfully more than the current prices under that scenario. They're also diversifiers because that particular action, whether or not it happens, is unlikely, I think, to be correlated with markets. So it's a really good diversifier for the portfolio. They're about 5%, I think, collectively of MVPA. And we think they have very significant multi-bagger potential. So that's the high-level thought process on those.
That's good. Thank you for that. And I think that wraps up the Q&A section of the presentation. Thanks again for joining us today. Don't forget you can follow us on LinkedIn and X and find content on our millervalue.com website, including recent commentaries from Dan and Bill, along with investment theses on many of our holdings titled What We Own and Why We Own It. We welcome your feedback in our efforts to improve the Miller Value client experience, and we look forward to updating you again in July.